In this video, I'm going to show you the journal entry to record depreciation. So you're going to debit depreciation expense and you're going to credit accumulated depreciation. Depreciation expense is going to go on the income statement. It's going to be an operating expense, so it's going to reduce net income, and therefore it's also going to reduce stockholders' equity on the balance sheet. Accumulated depreciation does not go on the income statement. It's going to go on the balance sheet, and it is a contra asset account. So that means it's going to be subtracted from property, plant, and equipment. You're going to have PP&E minus accumulated depreciation to get the net property, plant, and equipment. So when accumulated depreciation is credited, it's basically reducing total assets. And the reason is it's a contra asset, so it behaves the opposite way of an asset. Assets go up with a debit. Accumulated depreciation goes up with a credit. So when it goes up, assets are going down. So let's do an example. Okay, so let's say that you start a company called Death by Donut because you really like donuts and you want to help people lead healthier lives. So you purchase a donut fryer machine for $100,000 at the beginning of the year on January 1st. Okay, so you've got this machine, it costs $100,000, and you're going to need to depreciate it because it's property, plant, and equipment. So you expect the machine to last 5 years, and at the end of 5 years, it's going to be worthless. So it's going to have a salvage value of 0, and you're going to use straight line depreciation, which just means you're going to depreciate that $100,000 evenly over the 5 years of the asset's life. So when you buy the machine, assuming that you paid cash, you're going to credit cash for $100,000 and debit machine or equipment, something like that, some PP&E account for $100,000. That's just to put the asset on the books. But at the end of your first year, so you start on January 1st, you bought this asset, so let's say this is December 31st of year one, you're going to debit depreciation expense for $20,000. Again, that's going to go on the income statement. That's going to reduce your profit. And then you're going to credit the accumulated depreciation for $20,000, which is going to go on the balance sheet as a contra asset. So on the balance sheet, it would say machine of $100,000 minus accumulated depreciation of $20,000, net value of machine $80,000. Now, at the end of year 2, you're going to make another adjusting journal entry because it's straight line depreciation. It's going to be the exact same entry. Debit depreciation expense, credit accumulated depreciation for $20,000. Now, if you were to make a T account at that point in time and you say, okay, here's my accumulated depreciation, you would have $20,000 from year 1, $20,000 from year 2, you would have $40,000 of accumulated depreciation. And in year 3, it would go to $60,000 and so forth. You would keep making this adjusting journal entry unless you sold the machine. So let's say you sell the machine at the end of year 2. You're going to have to make a journal entry to get rid of the accumulated depreciation. You're going to have to debit the accumulated depreciation for $40,000. Why? Because you no longer own the machine. If you sell the machine at the end of year 2, you have to say, hey, look, I had $40,000 of depreciation accumulated for it. Let me debit accumulated depreciation for $40,000. So let's see how that works. So let's say you sell a machine for $60,000 cash at the end of year 2. We know you're going to have to debit the accumulated depreciation for $40,000, but you're also receiving $61,000 cash. So we're going to have $101,000 in debits here. We're going to need to credit some things. Well, the machine was on the books at $100,000. How do we know that? Well, if we go back, that was our initial journal entry, $100,000. So we credit machine for $100,000, but we have credits of $100,000, debits of $101,000. We can't have that. We need our credit of $1,000, and that is going to be a gain. It's going to be a gain, which is going to go on the income statement, and just like revenue, it's going to increase the company's profit. So we're going to have a gain on disposal of $1,000. So now our debits equal our credits. So when you dispose of a machine early, you have to debit the accumulated depreciation account so you can get rid of any accumulated depreciation associated with the machine that is being disposed of.